Tonight you check your bank balance. The number looks familiar. It looks safe. But between last month and this moment, something quietly took a slice of everything you earned, spent, saved, and stored. And it did not leave a receipt. This is not a fee you agreed to. It is not a line item on your statement. It is not illegal. It is the oldest financial mechanism in modern economic history, and right now, it is the most aggressive it has been in 4 decades. It has a name. Economists call it inflation. But that word does not capture what is actually happening to your money every single day you hold it in a standard savings account, earning 0.4% annually, while the real cost of your life climbs at 3, 4, sometimes 9% per year. What is actually happening is a transfer. Silent, systematic, institutional. Your purchasing power, the actual unit of real-world value stored inside every dollar in your account, is being redirected, not stolen in the dramatic sense, transferred from the people who hold idle, low-yield cash to the people and institutions who understand exactly how this system works and have positioned themselves on the correct side of it. Milton Friedman, the Nobel Prize-winning economist who spent decades decoding monetary systems, put it simply, inflation is taxation without legislation. You did not vote for it. You did not sign anything, but you are paying it every single day. Here is where it gets precise. The U.S. Bureau of Labor Statistics tracks what they call the Consumer Price Index, a broad basket of goods and services that represents your cost of living. Between 2020 and 2023, that index rose by approximately 19% in cumulative terms. That means something that cost $1,000 in early 2020 cost roughly $1,190 by 2023. If your savings account earned you the national average of 0.4% annually over those same 3 years, your balance may have grown by about $12 on $1,000. You lost, in real purchasing terms, close to $178. You never saw it leave. The balance never went down. But the purchasing power, the thing that actually matters, quietly evaporated. This is not a new phenomenon, but the scale of it in the current era is structurally different from any period in recent memory. And understanding why requires going one level deeper into how modern money actually works. When a central bank, the Federal Reserve in the United States, the European Central Bank across the Atlantic, the Reserve Bank in India, needs to stimulate an economy, it does not print physical currency and distribute it door to door. It does something far more sophisticated and far more consequential for your savings account. It expands the monetary supply through a mechanism called quantitative easing. Think of it as the central bank purchasing enormous quantities of financial assets, government bonds, mortgage-backed securities, and injecting the equivalent value into the financial system as newly created reserves. Between 2020 and 2022 alone, the Federal Reserve expanded its balance sheet from approximately $4 trillion to nearly $9 trillion. More dollars chasing the same goods. The arithmetic is not complicated. The consequence is not random. Your dollar buys less because there are simply more dollars competing for the same finite supply of things. But here is the counterintuitive twist that most retail bank customers never reach because they stop thinking at the surface level. The inflation that erodes your savings account did not erase that value. It redirected it. Asset prices, stocks, real estate, commodities, index funds climbed aggressively during the same period that cash savings were losing real value. A person who held the S&P 500 from March 2020 through the end of 2021 saw roughly a 100% nominal return. A person who held that same capital in a standard savings account saw approximately 0.8% over the same window. The inflation tax did not destroy wealth. It reallocated it, from savers who held cash to asset holders who understood the mechanism. The economist and author Ray Dalio has described this pattern in what he calls the long-term debt cycle, a multi-decade arc in which debt expansions, monetary supply inflations, and currency debasements systematically disadvantage savers who hold fiat currency and advantage those who hold real productive assets. Dalio's research suggests that throughout history, in virtually every major economy that has experienced significant monetary expansion, the outcome is the same. The gap between those who understand the system and those who simply trust their bank account grows wider. But the invisible tax is not only about inflation. It operates through a second mechanism that is even less visible, even more insidious, and built directly into the architecture of your daily spending. It is called the velocity of money drain, the slow compounding cost of every micro decision your financial behavior makes on autopilot. Consider your debit card. When you tap it at a coffee shop, a parking meter, a supermarket, the transaction feels free. It is not. Every swipe routes through a payment processing network, Visa, MasterCard, or similar, that charges the merchant a fee of between 1.5 and 3.5% on each transaction. The merchant does not absorb that cost in silence. It is baked into the price of everything you buy. You are paying a hidden transaction tax on every purchase you make with plastic, every coffee, every grocery run, every tap. According to research from the Federal Reserve Bank of Boston, cash users in the United States effectively subsidize credit card reward systems, paying inflated prices to fund the cashback and airline miles that flow to cardholders spending above their means. The people who carry high-interest revolving balances pay the steepest price of all. Then there is the silent compounding drag of money at rest. A 2022 Federal Deposit Insurance Corporation analysis found that a significant proportion of Americans hold the majority of their liquid savings in accounts yielding less than 1% annually. Accounts offered by the same institutions that are simultaneously borrowing money in the interbank market, generating returns of 3, 4, 5% on those same deposited funds. Your bank is arbitraging your savings. It accepts your capital at near zero yield, deploys it into higher returning instruments and lending products, and captures the spread. The infrastructure of this system is not hidden. It is public record. The business model of a commercial bank depends entirely on the fact that most depositors never ask the question, how much is my money actually working for me right now? The answer for most people is barely at all, and the compounding effect of that gap is devastating across a 10 or 20-year timeline. $100,000 parked at 0.4% for 20 years grows to approximately $108,000 in nominal terms. That same sum invested in the S&P 500 index over any comparable 20-year rolling window in modern history has historically returned between 8 and 10% annualized, growing to somewhere between $460,000 and $670,000 in nominal value. The difference between those two outcomes is not intelligence. It is not access to secret information. It is whether you understood that holding idle cash at a commercial bank in a low-yield savings account is not a neutral financial decision. It is a decision that costs you compounding every single day. This is where behavioral economics enters the picture. The Nobel Prize-winning psychologist and economist Daniel Kahneman, whose research on loss aversion and cognitive bias reshaped modern financial theory, documented a consistent human tendency. We evaluate wealth relative to a fixed reference point, usually the number on our bank statement. Because that number is not decreasing, we read the situation as stable, safe. But Kahneman's research reveals that this is precisely the kind of nominal framing that financial systems and the institutions operating within them exploit. The visible balance creates psychological safety. The invisible erosion creates real-world loss. You do not feel it until years later when the same income supports a measurably smaller life. Now turn the lens directly on your situation today. Open your banking app. Look at the account where your emergency fund sits. Look at where your short-term savings are parked. Ask the question the system does not encourage you to ask, what is this money actually earning versus what is this money actually losing in real purchasing terms right now? If the answer is a spread of 2, 3, or 4% in the wrong direction, you are not saving. You are slowly spending the future value of your own labor into a financial infrastructure that was designed, down to its deepest mechanics, to profit from your inertia. The invisible tax is not accidental. It is not a conspiracy. It is simply the logical outcome of a system built by people who understood compound interest, monetary mechanics, and behavioral psychology, and calibrated every product, every interface, every interest rate structure around the overwhelming likelihood that you would not. Tonight, you checked your bank balance. The number looked familiar. It looked safe. But now you know what the number on that screen does not show you. The gap between what your money says it is worth and what it can actually buy. Growing wider, invisibly, compounding silently. Every single day, you choose not to act. The question is no longer whether the tax exists. The question is whether you are going to keep paying it.